Hey everyone, it's Scott Wertanen over at Honest Rate. Today I want to talk to you guys about borrowing from your home equity. So this is, you already own a home, and we get a lot of phone calls and a lot of applications for folks that they have a house and what they owe on the house is significantly less than what it's worth. And that difference between what they owe and what it's worth is their home equity. So they're looking at how can I access it? And really, there's a handful of reasons why folks want to access it, and it's really your prerogative. But traditionally, like the most common things that we hear from folks are they're looking to do home renovations and they want to borrow from the house to finance it. Maybe you have some other debts that you want to pay off. Use that equity loan to consolidate the other bills. You know, maybe you want to borrow that money and use it for something else. Buy another property, invest it. We have a lot of folks borrowing money and then investing it to make a larger return than what they pay back on interest. And traditionally, there's really three major types of loans that you can access or you can use to access the equity. The first one is a home equity line of credit, which is a HELOC, is what a lot of folks will refer to it as. We love our mortgage lingo and jargon. There's a home equity loan, which is referred to as a HE loan. Instead of a HELOC, it's a HE loan, so it's number two. And then there's a traditional cash-out refinance is the third one. And there are some other nuanced products out there, some other things. I'm not saying that these are the only three in the world you can do, but these are the three most prevalent requests that borrowers are looking into. So let's go through those in order. Let's talk about the pros, the cons, some of the things that will come with that. So let's do them in reverse order. So the first one is the cash-out refinance or refinance, if you're a finance geek like me. So what is that? What is that loan? Like, what are the highlights of it? So really what it is that you're taking one new loan. So you're paying off what you owe. You're adding the extra cash back to you, financing if you have any money for taxes and insurance, closing costs, and you're just getting one new loan. It's a fixed rate, fixed term, traditionally, just like the mortgage you have if you have a regular mortgage against the house. So if you bought your house with a 30-year fixed and you said, hey, I want to do a cash out refinance with a new 30-year fixed, you're going to pay off the old loan. You're going to add like everything to it, as I just mentioned, and get one new loan. Now, those loan programs qualify just like when you bought the house. Very similar. You're looking at income, assets, credit, value of the house to determine the equity, and a very similar process. So what are the pros and the cons, and why do certain folks opt for this type of a loan? So number one, it's one payment. So there's a lot of folks that we talk to that just want one payment. They don't want to have two mortgages. They just want one. So that's a benefit of it. The second is it gives you the traditional terms that you're used to. 30-year fixed, 15-year fixed, 20-year. We can do some odd terms. You can do like a 23-year loan if you wanted to, but it's the normal feeling process and loan and servicing that you're used to. That's why a lot of homeowners will use it. The other piece is that the qualifications in this type of loan, when it comes to the income and credit, can sometimes be easier. So if you're not in a perfect position credit-wise, doing a regular refinance may be your best and easiest route to go. Sometimes it's the only choice to qualify. Sometimes it's the best terms when it comes to rate and payment, closing costs, and those options. So, it's a very common one that we see. One of the common reasons why some people don't use it is if they already have a first mortgage that they want to leave as is. They don't want to touch it. It doesn't make sense for them financially, whether it's because that interest rate is extremely low and they want to leave it as is, or maybe there's some sort of financial game plan with how quickly they're going to pay it off, or there's multiple people on the first mortgage, so redoing it makes it complicated. So a lot of it will be driven based off of the goals and the qualifying, but those are some of the general highlights of doing a cash out refinance. The second one is doing what's called a HELOC, which is these next two, HELOC and HELOC, are second mortgages essentially, or can be a third mortgage if you already have two mortgages. But essentially it's a standalone mortgage, it's standalone financing by itself. So it looks at the equity in the home for what you already owe. So what do you have on your first and second mortgage, or what do you already owe? What is the home value? And that difference would be what you could potentially borrow on a HELOC. Traditionally, the benefits, if we go back out to the cash out refinance, most of those loans will let you borrow up to 80% of the house value. So when you're looking at a house, if your house is worth $300,000, 80% is $240,000. A HELOC or HELOC fall in similar category in that they may allow you to go above that 80% mark. Maybe you can go to 85% or 90%, or I've seen throughout my years, not so much recently when I'm recording this video, but I've seen in history that some of those loans will go to 95%. I've even seen 100%. There's always caveats with that of what kind of credit score it takes to qualify, what are the terms, the interest rate. Usually the higher you go up in that, what we call loan to value, is going to change the terms of the loan. So they give you optionality. It's always good to compare. But let's go back to HELOC. HELOC is a second mortgage with a fixed rate, fixed term that works similar to a first mortgage, except now you have two loans. So let's say you wanted to borrow $50,000. You already owe $200,000 on your house. You would leave the $200,000 alone. You would take one new loan for the $50,000, and then that would just be set up on whatever length of the loan and interest rate and all of that jazz. So it could be a 15-year or 20-year or 30-year HELOC, and you just have one loan, or excuse me, a second loan with one payment paying back what you borrow on the home equity. So if you borrow $50,000, you now have a new payment just for that $50,000. So what are the pros of why some folks might take a HELOC? I think we talked about it briefly, which is if they have a reason not to refinance their first mortgage, they want to leave that as is. Maybe they have a project that is short term. They need the financing for something that they're going to borrow now and pay it back, in a year or two. So they don't really need to redo the whole loan. They just need that money to get them what they want for their goals. Maybe they're buying a property and they want to fix it up and renovate it with the cash from the HELOC, and then when they sell the house, they'll pay the HELOC back and then be done. So that's another reason. What are some of the cons? Well, qualifying can be a little harder because it's a second or third mortgage. So you might need higher credit scores. You may need more income compared to the debt. And there's some additional hoops to jump through, potentially. Sometimes it's easier. So it's just a matter of your specific scenario. And I think it doesn't hurt to compare. And most people we talk to look at multiple options to compare them side by side. All right, so the last thing, HELOC. So that is a home equity line of credit. Works very similarly to what we talked about on the HELOC in the sense that it leaves your first mortgage as is. You don't touch that. You just get a new loan as a second, but instead of it being a fixed rate and fixed term, it is a line of credit. Works very similar to a personal line of credit or a credit card. It's just using the home value in the home as collateral. So again, let's go through the example. Let's say you owe $250,000. Your house is worth $500,000. So you're like, I want to tap into some of the equity. Well, now you apply for a HELOC. And again, HELOCs may limit you on what percentage of the total value of the home. So it's not the percentage of the equity. So if you owe $250,000 and the house is worth $500,000, they're not giving you 80% of that equity or 70% or 90% or whatever you qualify for. They're giving you the total value of the house as a percentage. So let's say you could do a HELOC and that limits you at 80% of a $500,000 house. So that limits you to borrowing $400,000 total. If you already owe $250,000, well, now the difference is there's $150,000 in available equity. Same logic as the HE loan, but this is a line of credit. So you can have access to it, but it doesn't mean you have to borrow it. So let's say you're like, hey, I need $50,000 for what I'm looking to do, and I want to get that money right now, but I want access to $150,000 in total. So you could do a home equity line of credit, borrow the $50,000 you need, leave your first mortgage alone, and then you have the line that allows you to borrow the extra $100,000 if you need it. So $50,000 today, available for an extra $100,000 to $150,000 total in the future. So just an example of how that could work. Now on the line of credit, oftentimes the interest rate is variable, so it'll fluctuate based off of what's going on in the markets. Usually tied to prime or something to do with prime. The loans usually have a draw period, 3 years, 5 years, 10 years, where you can borrow against and pay back. And then in that period, it's usually interest only. So whatever your interest rate is compared to your balance, you're making just required to make the minimum interest only payment. And then after that period, it kicks into a fully principal and interest loan. So let's say it's a 10-year draw period. Then for the first 10 years, you can pay and draw as needed. You just pay the interest as a requirement. And then after 10 years, it turns into a 20-year payback at that point in time. So hopefully that gives you a little insight into the differences between them. As always, my take is this, is that you should do the research and compare. You should look, if you're looking to get home equity, you should look at the HELOC, the HE loan, the cash out. Like, it doesn't hurt. Someone like me as a mortgage broker, we're going to show you the options, and then you can decide what you think best fits your goals. It doesn't take multiple applications. You just do it all in the same process, so that makes it easy. And then really at the end of the day, it's really customized to what makes sense for you. So I gave you all some just general ideas and examples of, if you owe this and the house is worth that, and if you have these goals, but really based off of goals, based off of qualifying, and then based off of available rates and terms, whenever you do look into it, it could vary. If we talk today, a home equity line of credit might be your best choice. If we talk in 6 months, maybe a regular cash-out refinance is your best choice. And then heck, a year from now, maybe the HE loan just really fits your needs. So it really depends on, in the moment when you're applying, what's available, what do you qualify for, and what accomplishes your goals. As always, we look forward to helping you out. We'll give you as much advice as humanly possible. Feel free, you can call me directly at 216-998-0123, or you can always go to honestrate.com, interact with us there, fill out the information, chat, text, whatever you need. We're more than happy to be a resource and help you out. So thank you again for checking us out, and have a wonderful day. We'll talk to you soon.